Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're looking at how human behavior can very predictably damage the global banking system. There are many examples and many repeated opportunities in history to see this phenomenon at work. But on today's show, we're going to look at a very recent example that most of us can easily relate to. In the early days of the pandemic, we started to experience shortages of everyday staples. Households emptied the grocery store shelves of non-perishable food products like canned soup, pasta, and rice, some prepared foods like frozen pizza, and everyone's favorite toilet paper. The human response to the risk of a shortage was to start hoarding. Paradoxically, it was the hoarding behavior that created the shortage. There was no change to the consumption of toilet paper in the bathroom, and there was no change to the supply of toilet paper. Everyone said, I'll make sure there's enough toilet paper for me and enough chicken soup for me, even if that means somebody else will not have access to toilet paper or chicken soup. Well, that was 2020. That was the pandemic. This is now. We're not experiencing global shortages any longer, so why are we even talking about shortages? Well, that's actually incorrect. We are experiencing shortages, and we're seeing the exact same behavior that we saw with toilet paper. We're seeing people starting to hoard their cash out of a sense of anxiety about the banking system. When people withdraw funds from their bank account because they're worried about financial stability or worried about liquidity in the financial system, they're helping their own circumstances temporarily, but creating a self-fulfilling prophecy globally. Pulling money out of the banking system and parking cash in T-bills makes less available for the banks to lend. It's reducing liquidity in the banking system, and just like hoarding of toilet paper, banks are scrambling to find cash to solve their cash shortages. So with all this printing of money, how can we have a shortage of money? Well, if you listen to Treasury Secretary Janet Yellen or Federal Reserve Chairman Jerome Powell, the banking system is sound and resilient. Those tasked with financial oversight seem focused on stamping out rumors. They're blaming speculators for market volatility. Bank stocks have been on a wild ride for most of March. The latest casualty is Charles Schwab, the stock brokerage firm, where the stock lost 25% of its value on Friday. The company has a large bond portfolio that's carrying $29 billion in unrealized losses on its balance sheet. Well, back in 2008, the SEC banned naked short sales of banks and major financial institutions in the wake of the failure of Bear Stearns. The SEC blamed the failure of Bear Stearns on rampant speculation. If that indeed was the root cause, the rule change eliminating naked short sales should have been enough to stabilize markets. But then along came Lehman Brothers less than 60 days later. Maybe, just maybe, the speculators were not the real cause. Gosh, even back in 1971, when Richard Nixon took the US dollar off the gold standard, he blamed speculators as the reason for the change. So why is there a run on the bank? Why has there ever been a run on the bank? Is it the customer's fault? Or rather, is it a failure to maintain customer confidence in the bank and in the system? Some have argued that the banks need to hedge their portfolios more aggressively. So let me get this straight. The Federal Reserve keeps interest rates low for a decade. They're basically at the zero bound and in some cases negative. They then skyrocket the rates from 0 to 5% in a year, and they're shocked when the bond market implodes and there's a destruction of collateral in random locations. Did the investors who sought the safety of bonds, who bought long bonds, including U.S. Treasuries, the safest paper out there, did they make a mistake? Or is it a myth to call the U.S. Treasury the safest paper out there? After all, the U.S. has already exhausted the U.S. debt ceiling and is relying on extraordinary measures to keep the government operating until the last possible moment. The government will have fully exhausted their sleight of hand tricks in June, but in the meantime, they seem no closer to figuring out how to avoid the financial cliff. Remember, when the decision was made in December to kick the can down the road, there was no banking crisis capturing the headlines. So now legislators are tasked with convincing the public that they have the federal budget under control. These are the same folks that are telling us that the banking system is sound and resilient. And meanwhile, if you've recently tried to withdraw a large sum of cash out of your bank account, you would know just how much resistance you would get to withdrawing your own funds. This is the same as trying to convince consumers there's no shortage of toilet paper when they can see for themselves that the shelves are empty. Meanwhile, the same legislatures are out there blaming speculators. And when a balloon pops, you can expect the pin to get the blame, even though it's not the pin's fault. If only they could find the pin. It's a bit like looking for a needle in a haystack. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.